Hello, and welcome to FACT's webinar, Unpacking the Schedule F, Tips, Terminology, and Common Questions when Filing Farm Taxes. I'm Samantha Gasson, FACT's Humane Farming Program Director, and I will be moderating this session. Thank you so much for joining us. Before we dive right in, let me take a minute or two to do a few quick introductions. Food Animal Concerns Trust, or FACT, is a national nonprofit organization that works to ensure that all food-producing animals are raised in a humane and healthy manner. We accomplish this by supporting humane farmers through our Humane Farming Program, promoting policies that make foods from animals safe and healthy to eat through our Safe and Healthy Foods program, and generally help consumers make informed food choices. You can visit our website at foodanimalconcernstrust.org to learn more about our farmer services. As always, I would like to thank my wonderful colleague, Catherine Hoke, who is joining us to help field questions and take over if my internet decides to be uncooperative, which is something it's been doing all day long. So it is, hopefully it won't happen. Hopefully I can hold on. All right, at this time, I'm delighted to introduce one of my favorite people, Andy Larson with Food Finance Institute, also known as FFI. Andy consults with entrepreneurial farm businesses in Wisconsin and beyond to build farm financial management capacity and help them access the capital they need to grow. He provides one-on-one business counseling and educational programs like Farm Finance Boot Camp. Previously, Andy worked as an agricultural lender at a community bank and as a small farms extension director in Iowa and Illinois. Andy and his family own and operate a small-scale pastured poultry enterprise just down the road from the dairy farm where he grew up. I didn't know that about you. That's really cool. They produce free-range brown eggs for local restaurants and retail stores. And like I said before, if you live within a 200-mile radius of Washington, D.C., you can apply for FFI's Farm Finance Bootcamp, and I will put a link to that Google form in the chat in a few minutes. So we're super lucky to have Andy with us today. And without further ado, Andy, I will turn the floor over to you. Take it away.
Thank you so much. And I am super lucky to be here, and I'm super lucky to have 80 some people and counting that are joining us for this thing. That's really, really cool. Give me a quick, let's see how these reactions work. We're just going to do a little testing here real quick. Give me a show of hands for folks who have never filled out a Schedule F for their farm yet, that this is a brand new thing to them. Okay, so it shows a bunch of little yellow hands in the corner. Okay, I see a lot of little yellow thumbs floating up. And I don't know if I'm going to be able to enumerate this or not, but how many people have filled out the Schedule F one or more times and filed these things with their tax returns before? All right, so it looks like there's a lot of thumbs floating up now. So it looks like there's quite a few of you who have done these things before, and you might just be looking for a little bit of additional clarity or clarification around what the thing does, what it's for, how to fill it out correctly or incorrectly. And we're going to dig into a lot of that stuff over the course of the next hour. Now, I also want to say that there is more detail than we can cover in an hour. And full transparency, I am not a tax specialist of any sort. So I want everybody to be aware that I'm sort of a practical accounting and bookkeeping nerd and not like a formally trained one, classically trained tax accountant or anything like that. So I'm going to give you the answers that I feel like are going to keep you from getting stopped up and are going to be able to continue to do your work. So very much thanks to FACT for inviting me to do this. This is my contact information. This is the folks that we have in FFI as our consulting staff. All of us are experienced professionals in our respective fields before we became consultants. And if you are looking to grow your value-added farm or food brand and you need some outside consultation, this is a great place to look for some professional help. The first thing I want to say is that the Schedule F document is just one front side of one page, you guys. It's not that scary. It's a jargon and instruction kind of barrier. And so we're going to get through some of the jargon and instruction kind of stuff. And I'm going to tell you where to find it too after this webinar is over. So this isn't the only time you're going to see this stuff. The Schedule F itself, of course, is the main tax document that we're using to report our profitability for our farm business. It is explicitly for sole proprietors, single member LLCs, and certain trusts and estates. So if you just so happen to be an S Corp or a C Corp or whatever, you won't be using the Schedule F as your main reporting document. Instead, you'll be using your 1120 or your 1120S. So we're not going to go into those in a ton of detail or anything like that. I just want you to be aware of who this is most relevant to. Um, these are the instructions for following and filling out the Schedule F correctly. It is a live link on here. I can also get it sent to you guys later in email format. And here is a live link to the fillable PDF. Most of the stuff that I'm going to say, as far as the technical nerdy details, are included in this stuff around the instructions for the Schedule F. I'm going to riff and expound upon it just a little bit. But I want to make sure that you know that this information is out there. It's available to you. Um, Jessica, my old tax guy did, but I think he messed me up. I'm scared. I hear you. I was a banker for 4 years and I saw some Schedule Fs that were messed up. I saw one where every farm expense was reported under other. Let me see if I can get my laser pointer going. There we go. It was all reported down here. And that is bass backwards, you guys. It is not going to get you the benefits that you should get from filling out a Schedule F correctly, like depreciation, like, other things, like favorable tax rates, etc. So getting these things done correctly is important. And if you don't know how to do it yourself, bring in the pros. It is so useful and not that terribly expensive to find a tax accountant that knows how to do a Schedule F correctly. So, since there's some beginners in here, this is sort of a discussion question, but where you can't really discuss, so we're going to do it in the chat here. I'd love to see some opinions and some answers. When do you think you should start filing a Schedule F? Go ahead and type your answer in the chat if you would. I'd like to see people's opinions. Yesterday, Claire, you're funny. First day of the yeah. Okay, I see where people are going with this. Yeah, I didn't actually mean when during the calendar year or anything like that. I should have been a little bit more explicit. But yes, Robin, when you have farm-related expenses or when you have farm-related income, right from the beginning, Lynn, absolutely. First year, I agree with you. I'd say most of the time. Jessica, when you are starting to get scared about how much you've been doing under the table, oh boy, oh boy, oh boy, that is a practical answer right there. It's like, okay, I'm farming kind of a lot and I'm not telling anybody about it. Maybe I should figure out, how to report some of this stuff to the Fed so I don't get in trouble. Very, very good. Okay, I love these answers, you guys. Oh, and Shelly, I am going to go into that a little bit more about going from a hobby to a registered business, and I'll give you a resource for figuring that out. Okay, so right from the get-go is absolutely the right answer. When you start farming, especially as a business, generally with the intent to make a profit, okay? Yes, you can be a farm and not be profitable that year. I get it. Generally, you can be a farm and not be profitable for several years because stuff happens. But your intent is to be a for-profit business, and if so, you should probably be filing a Schedule F and when you have farm-related income and expenses. This link right here is a little IRS document that talks about when you're a hobby and when you're a business. So if you want to check that out, you absolutely can. It is not it's not rocket surgery. It's like if you're just doing this for fun, it's a hobby. If you're just doing this for loss, it's a hobby. If you're doing it because you're actually trying to make money at it, you cross that line into the business area. So if you need a little bit more help because you have a specific circumstance, this document can help provide some of that. The other cool thing about starting to file your Schedule F is it sort of starts your clock on your farm business, right? If you're ever going to be a lending customer with the FSA, the Farm Services Agency, you need to have generally 3 years of Schedule Fs under your belt, 3 years of farm management experience. Most of the time, if you're going to get a loan from a conventional lender, a bank, or a farm credit cooperative, they want you to demonstrate some history of farm management experience and record keeping and all that kind of stuff. As a beginner, do they expect you to do it 1000% right? No, not necessarily. Do they expect you to be wildly profitable right from the get-go? No, not necessarily. But just starting that clock and showing that you're doing your due diligence to be a legit business pursuit helps an awful lot. Okay, I'm just checking this out here in the chat. Very few of the printed expense categories pertain to our family farm. Interesting. Organic, veggie, local CSA, and farmers markets. No pensions, no chemicals, no hired labor. I get it. RC, I totally get it. But there are things that are going to fit. There are categories that are sort of lumped together on the Schedule F. But I'm going to encourage you toward the end to go beyond the Schedule F categories when you're doing your record keeping, because it is going to behoove you in your farm management. And we'll talk about why in just a couple of minutes here. So I'm going to go through some of the details in each of the different sections, the header, part one with the income and part two with the expenses, because there is some confusion around terminology. And so I want to get some clarity around a few of those things to begin with, and also continue to ask a few discussion questions as we go along. Do not be shy about popping a question into the chat. I'll do my best to take a gander at it as I go along, or Samantha or Catherine can let me know that something came in that is relevant to what we're talking about right now. So this header section that I got copied up here, man, it's hard to be an image-driven presenter and talk about a single-page tax document. It's just not that exciting from a visual standpoint, but I did what I could. So we're trying to figure out principal, crop, or activity. There's a big chart on the back of the Schedule F, on the back page of the Schedule F, that gives you all these different codes that are basically NAICS codes, NAICS codes, which are government codes for classifying different industries. And you're going to choose the one that most directly pertains to you. So that's your principal crop. You enter that code. If you do not see a code that's on here that relates to what you do on your farm, if you are principally agritourism or agritainment, if you're principally a wedding barn, if you're principally a food truck or whatever, the first question you got to ask yourself is it practical for me to be using a Schedule F as my primary tax document for this business? Or should I be a Schedule C, or should I be something else? We'll talk about the differences in just a couple of minutes here. So that's the first and foremost part. It's a small number of codes for a large number of possibilities. And I recognize that some of you are going to be in the other crop or other animal production type of categories. What codes would you use for hay? Great question, Yvette. That would be in your other crop farming, I would say, would be the best category for that. Are equine considered other animal production? Kara, it really depends on what you're using equine for. So if you are a racing farm, a boarding farm, or there's another category too, where you're not like in the agricultural production of livestock and selling of genetic stock and all that kind of stuff, they might not even consider the Schedule F an appropriate tax document for you. You can see on I think it's on the makers table that I have here. Just a second, I got about 1 million tabs open, that they categorize everything just a little bit differently when we're talking about horses. So we got these different sections about breeding or workhorses, at different ages, race horses, neither racehorse or workhorse, so like they really kind of get into the weeds around horses. But as far as that general code is concerned, yes, I would say that you're going to be in the other animal production category. Great questions, you guys. The next thing on that header piece is the thing about accounting method. And I want to tell you, I have never seen anybody check, excuse me, amongst my clientele, I have never seen anybody check anything other than the cash accounting method. So being an accrual accounting business, means that you're doing things that are a little bit different from a bookkeeping standpoint, right? You're recognizing income when it's billed as opposed to when you receive the cash in your hot little hand, right? So if you do custom farming and you do some custom harvesting for a neighbor that year, you're going to recognize the income as soon as you bill that other farmer for the custom harvesting that you've done. However, that person may not actually pay you a check until after the first of the year, in which case, in the cash accounting method, you would be moving that income into the following tax year. What's the difference, Larson? Why do I care about this stuff? Well, cash is more typical for small businesses. It is a little bit more simple and straightforward. And we have had a lot of creative tax accountants figure out how to do interesting stuff with tax documentation in order to make it beneficial to the taxpayer. Optimizing income tax burden is probably the phrase you'll hear me say a couple of times today. Um, so you can be an accrual accounting farm, but the only people that really absolutely have to be, at least starting, for this year, are folks who have had $31 million in revenue, in annual gross receipts for the preceding 3 years. That eliminates, I expect, most of the people on this call. It certainly eliminates me. So the cash method is what most people are going to claim. It's going to ask whether or not you materially participated in the operation of this business. Most people are going to know in their gut that they're the sole proprietor, they're doing the work, we are materially participating in this thing. There are other folks, like folks who are mostly retired in a multi-generational family farm who, there's a question as to whether or not they're materially participating in the operation of the business. The way that they define that is down here. You've spent 500 or more hours, about a quarter time in an FTE standpoint, in working that farm. You've worked 100 plus hours and you've worked more than anybody else who has worked on that farm. So that 100 plus is the greatest amount. That's material participation. You have done substantially all the work, even if it's a different hour amount. You would have met that threshold, but you died, in which case you are less concerned about filing your taxes, but your spouse probably still has to. And the quote from the rules, you participate in the farm on a regular, continuous, and substantial basis. The only thing that this is doing is that making sure that if you accrue any losses through your farm businesses, that those are not considered passive losses. They're active losses from active pursuit of business, and that is going to affect your tax burden at the end of the year. If you have multiple enterprises like vegetable and poultry, what do you put? The main production, the one that you have the greater sales revenues, Piran. So, like, whatever is going to be the greatest volume of sales that come through your farm business, that's going to be the one that is the code that you will use. So that first top header section usually doesn't have a ton of questions around it, but has anybody else got any curiosities? Go ahead and plop them into the chat real quick here. Otherwise, I'm going to get started on the farm income part.
Hey, Andy,
Yeah,
I
Sam, go
do.
ahead.
So this question sort of it relates to the other slide. Does a farm need to be a registered business in order to file a Schedule F?
No, it does not. And by registered business, I assume they mean a legal entity that is formed either through an LLC, a partnership, a C Corp, an S Corp, or something like that. Um, no, it does
But
not have to be. A person who is a
but they do
sole
have to have a they have to have an EIN number though, right? Or can that be a social?
That can also be a social security number. So if you're just farming personally and you haven't done any kind of broader order registration with the state or feds or municipality, you can still be a farmer. You'd stick your social security number in that thing on the upper right-hand corner. Most of the time, the only thing that you've really got to do, at least in Illinois, and this could be very different in other states, is publish the fact that you're working under this assumed name, this DBA, and you publish that in the newspaper for like 2 weeks. God knows who actually reads newspapers anymore, but whatever you did your due diligence to be out there and make it known that you're operating under this DBA. Otherwise, you can just operate under your own name as well and still fill out a Schedule F. How about custom grazing? I'm not actually selling any livestock. Very interesting question. You're kind of like an agricultural service business in that case, aren't you? What I would probably be using in that case is the beef cattle ranching and farming. It doesn't actually say that you have to own those beef cattle. You're grazing those beef cattle and you're making agricultural decisions on the production of those beef cattle. So I still feel like it's a perfectly legit thing to claim that you should fill out a Schedule F and have profit and loss from farming, even despite not technically owning the asset, all of the assets, either the cattle or the land or both. Good questions, you guys. All right, let's talk about the income just a little bit. Um, oh, Joni, $10 to your town to get listed as a business, and there you're registered. Bob's your uncle, you're a registered business. Okay, very good. Yeah, it's going to be a little bit different state by state, municipality by municipality, but it's usually not an onerous process to be registered as a business. It usually doesn't take much more than just saying you're a business and filing some paperwork in your taxes that you did business. Okay, for whatever reason, line one on the farm income part of the tax return is not what people expect it to be. They expect it to be line two, right? Line two, sales of livestock, produce, grains, and other products you raise. That's the place where you're reporting the things that you grew, the things that you raised, the things that you sold. Like that's your farming product. That goes into line two. Line one is an opportunity that's most frequently used by livestock farmers who are buying and selling at different ages or different sizes or different weight classes or whatever. And they have a cost basis in that critter that they are raising up, feeding out, and selling as a market animal. So for an example, if you spent $1,000 or excuse me, if you spent $200 on a critter and you sold it for $1,000, so you subtract that initial $200, that cost basis from the revenue you received from selling that animal. So that $800 is going to be your difference. The one other thing that I think is important for the folks that are here today to know about is that that line can have some limited use for resale items that are not necessarily livestock that you're growing out. For example, as an egg farmer, I buy eggs from another farm and I wash and grade and pack and deliver those eggs under my farm name. Okay, so I have, instead of incurring a cost of production for those eggs, I've incurred a cost of goods sold. Like I bought those dozens of eggs from the other farmer. And so I have a cost basis in them. Whatever I sold those eggs for minus whatever I paid for them, that is what I put on line 1C. So when you're talking about aggregating farm product from other farmers, that is a good place to do that as well. Now, once you start getting into finished product, like if you bought jars of salsa and then sold jars of salsa and it was more of a value added product, then you're really starting to push the boundaries of what the Schedule F is for. Is it possible for you to do that if you've got a little farm store and you sell a few other things? I wouldn't worry about it. I don't think anybody's going to come after you for putting salsa up there or whatever it is. Okay. Not and again, this is practical advice, not legal technical advice. I do a lot of hand waving around things that I think are silly. And so we'll talk about one of those things in just one more slide here. Like I said, line two, that's the one that everybody thinks of. That's usually going to be the largest line, depending on the type of business that you're operating. That's the farm products that you raised and sold yourself. Okay, I'm not going to spend a lot of time on this chunk. 3, 4, 5, and 6 are sort of like weird, specific things that a lot of people do use in specific circumstances, but there doesn't tend to be, it tends to be lower utilization and fewer questions about things. So co-ops distribute patronage, right? You get a check from your co-op, whether that's a farm credit cooperative or an ethanol plant or a farm input co-op. They'll send you a check because you're a member of that co-op, an investor in that co-op. That's where that goes. Ag program payments, there's a lot of ad hoc payments out there, you guys. There's a new one with every president, it seems like. ARC PLC has been around for a while. There's coronavirus food assistance. There's the market facilitation program, which happened last time around. All those kind of payments can go into line 4. Line 5 is there's a little bit more confusion around it because the Commodity Credit Corporation is involved in a number of different farm finance venues. This is primarily for market assistance loans. What those are is that you can get a loan from the feds for product that you have raised but have not sold yet. And if you happen to sell that stuff for less than the loan amount that you receive for it, you can just forfeit it. And that means that the income that you receive from the loan is what you would report as the actual income on line 5. 6, crop insurance payments. Crop insurance is a thing for an awful lot of farmers and ranchers. It is not a thing for a lot of small specialty and niche farmers and ranchers. So if you receive crop insurance proceeds, if you have crop insurance and you receive proceeds, you'll know it. Where does grant income go? Oh, we're getting right there, Megan. It's on the next slide. We're going to talk about grant income because I know that's a pertinent thing for a lot of people on this call. Custom hire. People get a little bit confused about this. Custom hire is when you are bringing in equipment or expertise or both from another operator and doing something on your farm, right? So you can be that provider as well. You can be a person who does custom planting, custom haying, custom combining, custom fertilizer application, custom a lot of stuff. If you are a custom whatever, there's a chance that you have some custom hire income. And that's where you report that thing. The other line is the one that gets to be pretty diverse. Rental income, breeding fees, grant proceeds are going to go under other. When you are accounting for your grants, Megan, I would strongly advise you to keep the proceeds that you receive from the grant and the expenses that you incur as a result of the grant tagged, flagged, or otherwise separated out in your record keeping so that you can kind of keep those outliers separate when you're doing your trend analysis, your comparative analysis from one year to the next, and see these big spikes or big dips or otherwise big changes. It's easier to figure out how your trends are going if you don't have those sort of grant anomalies in there. Tax credits, speaking gigs, debt cancellation. Like a lot of us experienced a little bit of debt cancellation when we did those PPP loans back during COVID. Okay, so debt cancellation can go in there. Excess depreciation recapture. We're going to talk about depreciation in some detail when we get down into the expenses section. And the other one that people are always surprised to see is that bartering income down at the bottom. I don't know about you guys, but I trade eggs for a lot of favors. And I have yet to see a farmer that reports bartering income on the other income line. That is not to say that there is not anyone out there. If anybody has actually ever reported bartering income on your Schedule F, I'd love to see your little yellow hand pop up, your little reaction. But I have the feeling that that is a little used place on the other income line. So grants in particular, speaking gigs in particular, I know that a lot of folks in this realm do a lot of that stuff. Other income is going to be the perfect line to keep track of those things. Down at the bottom, they have gross income, and I put gross income in quotes because I don't think it is the best evaluation of gross income, and I'm going to tell you why. When I'm thinking about gross income, I think about gross and net, right? And these are things that farmers like a lot of times don't get taught in farmer school, which a lot of us didn't attend anyway, right? So when we're doing our accounting and we have this like very simplistic approach where there's a bucket of revenues, a bucket of expenses, and then profit or no profit, right? And I would argue that you can become a better farm financial manager by adding one twist, one step in that arithmetic. And let me show you what that looks like. So the Schedule C, which is right up here, which is the sort of the more used, sister document, tax document that non-farm businesses are going to use to report their profit and loss. They ask you to calculate something called your cost of goods sold. If you are not familiar with cost of goods sold, you're probably familiar with cost of production, because that's the way we refer to it a lot in agriculture. You may have also heard direct costs. You may have also heard, like, there's so much accounting terminology that gets kind of confusing. But that kind of stuff is it's a real benefit in the overall management capability to figure out your cost of goods sold. There's actually a little form on the back of the Schedule C, if I can find it. I have one opened here. There we go. That shows you how to calculate your cost of goods sold. And basically, you're using your balance sheet and its changes in inventory over the course of the year. You'll see that there's something like this on the back of the Schedule F as well. But because most people are electing cash accounting, very few folks ever see it. So really, cost of goods sold is the figuring out how much inventory you bought, how much inventory you sold, and how much you have on hand, and the costs of those different inventories together. So that's how they tell you to do it. I'm not going to go into that level of detail right now, but I would argue knowing your cost of production and knowing your gross versus net profitability is going to help you be more profitable as a farmer for several reasons. Let's see. For one thing, the Schedule F being just two big buckets of revenues and expenses, it only tells you if your farm is profitable, right? If you made money that year. It doesn't tell you how. I don't know too many farmers who only have one enterprise in their farm, right? I only sell eggs, but I sell my eggs and I sell somebody else's eggs and I sell chicken eggs and I sell duck eggs. Are those different enterprises? Arguably, yes. So even simple farms have got multiple enterprises, and knowing which of those enterprises are making you which proportion of your profitability allows you to focus on growing the ones that are already profitable and fixing the ones that are not. So that enterprise budgeting within the overall accounting system becomes really, really useful. I do hubby's machine shop Schedule C and my Schedule FC makes so much more sense. Yes, Joni, it does. In a lot of circumstances, it does, especially when people are familiar with non-agricultural accounting first. Yvette, hold that question. We're going to get to that question. Actually, I think we're going to get to it right now. I want to actually address that as a group. So, should I file a Schedule F or a Schedule C? That question becomes a little bit fraught. So the question I'm asking the group for you to respond to in the chat, when should a farm business also file a Schedule C? I'd like to see your opinions, please. Okay, interesting. Agritourism events, when you also have a job, well, when you have a day job, that's usually going to go on the main part of your 1040, Megan. When they sell value-added products, when they do non-farm work, when there's a partner, agritourism, when you're processing. Okay, good, you guys. Like, you're on the right track. And I'm going to argue that there is a practicality test with this too. So, the profit and loss from farming, you're using a Schedule F when you're doing farming activities, and not so much when you're doing non-farming activities. Okay, so farming activities, what are these? Farm Commons, which is a nonprofit that does legal work and legal outreach for small-scale farmers, says this: farming activities also include growing and harvesting crops, raising livestock or poultry, preparing unmanufactured farm products for market, and delivery to market. So I feel pretty confident that by the fact that the thing that I'm selling, even though it's wash, pack, graded, and in a carton, is still just an egg. It still feels like a farm product, and I don't feel like I need to fill out a Schedule C as a retailer or something like that. But what about my value-added product? My salsa, my barbecue sauce, my tapenade, my whatever. What about my food truck? What about my wedding barn? So, if the activity that you're doing doesn't fall within that definition in quotes of growing and harvesting crops, raising livestock or poultry, and preparing unmanufactured farm products for market and delivery to market, I would say that technically you probably are falling into Schedule C category. Now, I told you I was going to be practical about this. So, if you hold a farm tour and you sell tickets to that farm tour, that's not necessarily an agricultural activity. But if that's the only thing you did, would you bother paying somebody to prepare a whole nother tax document just because you made a couple $100 on tickets for your farm? I wouldn't. Just being honest here, just being practical here. So the agritourism folks, right? That all you put all that in the chat about all the different agritourism. If that is a large component of your income, I would argue that it is indeed worth it to fill out and file a Schedule C in addition to the Schedule F. As a matter of fact, I might even have a separate entity for my agritourism events because I want to be able to separate the liability that comes with having guests on my farm and perhaps, like drinking during a wedding or whatever, have that liability separated, have a veil between the liability created by agritourism versus the liability created by the farming. Okay, so there is some value in that. What obligation does that create? You got to account for it separately. And that becomes a little bit of a chore in order to do two sets of books rather than just one. I get it. If it's a small part of the stuff that you do and it goes under other income, I don't think anybody's coming after you with pitchforks, okay? I really don't. But the last thing you want to do is have it a major component of your business, report it incorrectly, and trigger some kind of government audit. That wouldn't be any kind of fun. So if your farm sells logo t-shirts, good question, Megan. Like, selling merch in my mind is something that is any kind of business has merch most of the time. We've sold t-shirts before. Does it feel like a farming activity? Well, no. Is it a major part of my income? No. Is it worth paying my tax accountant to fill out a Schedule C just because I sold t-shirts? That's up to your sense of honesty, integrity, and price. I know that everybody would love a very detailed, very exacting answer of when you have to start filling out a Schedule C. And I do see some mentions of value added and food processed products. Technically, those things are Schedule C type of products. If you're making salsa, barbecue sauce, and tapenade, I mean, or salad dressing, or any of those other things, that's all Schedule C, food manufacturing, food processing. Is it lovely to have an understanding of whether or not that processing step is what's making you money or the production step is what's making you money? Yes, absolutely. Why? Because if it's the processing step and the production step isn't making you any money, maybe you can buy it from somebody else and quit losing your shirt on producing whatever that thing is. All right. So the technical answer is that when you're doing non-farming activities, it is appropriate to have a Schedule C in your tax return. Is it practical? Are you concerned about it? That is up to your own sensibilities, in my opinion. Buying weanlings but don't sell them that year. Yeah, okay. So that's a balance sheet question, Joan. We're going to talk about accrual adjustments on your balance sheet and towards the end of the presentation. So hold tight on that one. Piran, we have two books, one for the cottage food, because we have that as an individual. You cannot have it as an LLC, and we have a farm LLC. Okay. So you have some regulations around what kind of entity you can be. And so as a result, two sets of books, two separate pieces of liability. Making and selling cheese made with my goat dairy milk is Schedule C. Man, that feels like it's right there on the line. Honestly, Jessica, is that food processing? Is there food safety concerns that go into that? Yeah, absolutely. Would you love to be able to separate out that liability? Yeah, but man, I also like the preparing unmanufactured farm products for market. It's like, yeah, I'm preparing them by manufacturing them. So like in reality, in technical speak, that should probably be a Schedule C thing. In reality, in non-technical speak, do a lot of people probably report farmstead dairy and cheese production under a Schedule F? Yes, in all likelihood. So, depends on how type A you guys want to be with all of this. Thomas, QuickBooks subscription. Yeah, I know. I know. Do I have to have another seat of QuickBooks in order to fill out my Schedule C businesses? Do I have to spend another $1,000 a year for QuickBooks Online in order to do a Schedule F and then report that to my tax accountant and pay another couple $100 to him for him to fill out the Schedule C for me? Does it still reduce my liability? It reduces your liability if you have your operating agreement written out correctly instead of just using boilerplate language of what an operating agreement for your LLC or schedules or your C Corp or S Corp do. You got to have your operating agreement up to snuff. You probably want to have it checked by attorney. It's worth that hour's worth of expense for the attorney, whether it's $150 or $300 or whatever it is, to have the peace of mind that you know your operating agreement is actually protecting you. So having the documentation correct about separating out one entity from the next, one liability from the next, gets really, really tough. And bring in the professionals is my recommendation. Could a good lawyer still pierce the veil between one entity and the other from a liability standpoint? Probably. I mean, they get trained in all those technicalities, right? And we're not. And I always have the argument that a good lawyer can find lots of loopholes and lots of things. Nonetheless, just by doing the due diligence that you should be doing in order to separate out those liabilities, I think that a lot of people would find you less liable for harm in that circumstance. Sam, did I
Hey,
miss a
Andy.
question?
No, well, you have missed some questions, but it's okay. We're telling people put them in the Q&A. I just want to give you a time check. You've only got 15 minutes left, and that includes questions and everything else. Just no pressure, but just let you know.
So light a fire under my butt, I think is what you're doing here. Thank you, Sam. I appreciate that. Let's get into the farm expenses stuff real quick, you guys. It's not actually going to take that long because there's not as much complexity in it as you think. In the car and truck expenses piece, either claim mileage. Yeah, we're going to get to depreciation, don't worry. You can either claim mileage or you can claim actual expenses. So for the person who's doing a lot of delivering to market, who's doing a lot of driving around, chances are the mileage portion at 67 or 70 cents or whatever it is probably going to be more beneficial to you from a deduction standpoint. If you have old vehicles that are sitting around and not going far, but they require a lot of expenditure for repairs and things like that, the actuals might be more beneficial to you. You do have to use actuals if you've got more than 5 over-the-road vehicles in your fleet. I have never seen anyone use the conservation expenses line. I hope some of you people in the audience today have indeed done so and spent some money on conservation. It does have to be consistent with a plan. So if you're working with the NRCS or DNR or whatever, that's where those expenses are going to go. It cannot exceed 25% of your gross farm income. We talked about custom hire already. So depreciation here, you guys, we're here. Depreciation is magic. Depreciation is confusing. um, Depreciation does not apply to personal stuff, right? You can't depreciate your home unless it's part of a piece of agricultural property or anything in your home. You don't depreciate your land. Those are not things that depreciate. Farm buildings, real estate improvements, as in improving those buildings, building a wash pack, etc. Cars and trucks, machinery, and other farm equipment of a quote unquote permanent nature, those are the things that depreciate. They get depreciated by a schedule. Each one of them has its own technical useful life. You have the general depreciation categories and you have the alternative depreciation categories. So this here makers table that I showed earlier comes at the bottom of IRS publication 946, how to depreciate property. So that's where you can look for that thing in order to get some of those specifics around depreciation. It's in other websites and everything too. Uh, the cannot, okay, excuse me. You can depreciate trees and vines bearing fruits and nuts. Okay. So if you're capitalizing the expenses for planting an apple orchard, for example, and you're 5 to 7 years out from harvest, you're going to be putting some money, some operating capital into the maintenance, into the production, into the productivity of those trees. And those expenses can be capitalized and depreciated, and you begin depreciating those out after those trees start to bear. Fencing does depreciate, Shelley. Yes, it depreciates generally over 10 years. Section 179 expense, you've probably seen that in the Schedule F. That's a thing that allows you to depreciate fully a capital item in its first year that's put into service. So this is that trick that you see a lot of folks go out and buy a new pickup truck in December because they made too much money that year and they don't want to pay taxes, right? So they can put that thing into service before December and fully depreciate the expense of the value of that pickup truck, the purchase price of that pickup truck in that 1 year in order to offset the income that they had in that tax year. Should you always do that? No, not necessarily, because I don't want you to get into an obligation that you otherwise are going to have a difficult time servicing. Most of the time, if you're buying a pickup truck, even if you made too much money, you're still getting a loan for it. And how does that affect your overall cash flow? Windbreak tree planting. You're not harvesting anything from that windbreak. I would call that a conservation expense, Rachel. Around an orchard. Talk to a tax accountant. I feel like that's an expense. And if it's a large expense, you could depreciate it over time. My big question on depreciation, only need to use it when you need it, like a deduction in the bank for farmers. Oh, well, true. You can expense most things in the first year if they're below $5,000 for price. That's sort of the de minimis safe harbor, whatever. But when you start getting into bigger order things like that, depreciation is really useful in order to optimize your tax burden. So I would say if you don't need additional write-offs in order to optimize your tax burden, then capitalizing and depreciating those items, even if they're less than that $5,000 threshold, is still going to benefit you by having depreciable expenses that you accrue in future years. And yes, it can be accelerated, it can be decelerated, there's general and there's alternative. This is where the tax accounting professionals come in real handy in order to do that stuff right. So, okay, that was what I wanted to make sure I had on there. Yvette, explain capitalizing. Thank you. Great question. So capitalizing just means it's capitalizing versus expensing. So if you buy a thing for $4,000, you can expense that 4,000. So I bought a commercial 2-door stainless steel fridge to hold my egg inventory, right? Cost me $3,000. And so I could expense that $3,000 all in that year in order to create an additional deduction to offset my income and reduce my tax burden. Or instead of expensing it, I could capitalize it, which means I don't recognize the full expense, the full $3,000 of that fridge. And instead, I depreciate that fridge over time. So if it's got a 5-year useful life, I'm going to deduct $600 in depreciation expense every year for the next 5 years for that fridge. So that's capitalizing versus expensing. And you can use that to your advantage. You don't necessarily need to take more expenses in order to further reduce your farm income. You can even carry forward losses if you want to, but that gets into, again, some more sophisticated tax maneuvering than I want to be able to talk about here. Conservation expenses are a limited deduction, not a full deduction. Like it's limited to 25% of your farm income, I believe, Jim. If there's other limitations to it, there could be, but again, more detail than I know about. Okay, more expenses. I'm not going to talk about these ones in detail because they're pretty straightforward. You've got this slide, you can look at it later. Um, Employee benefit programs, cost of transportation. So freight and trucking, you guys, line 18. If you're transporting livestock, you add the trucking to the cost of the livestock. Okay, so instead of having to tease that out separately. So I can add, if I had, eggs trucked in by a company, I could add the trucking to the cost of the eggs, for example. Number 19, gas, fuel, and oil. That's usually when you're filling your tank, right? And I don't mean the tank in your vehicle, I mean the standalone tank on your farm. Don't double dip with what you're putting in your tank from the gas station into your over-the-road vehicle. And number 20, people ask about this insurance one. It's the farm business insurance only. If you've got business insurance, if you've got farm personal property, if you've got farm liability, if you've got a commercial liability umbrella, all of that is different kinds of farm business insurance. So almost done with the expenses here, and then I have a couple questions that we might have to skip the communal thought questions in order to get through everything in the chat. Repairs and maintenance. Make sure that repairs and maintenance is fixing something as opposed to improving something, right? So if you're buying the supplies that you need to build a lean-to on the side of your barn, that's actually the improvement of real property. And it makes more sense to capitalize and depreciate that expense than it does to just write in the expenditure of those materials. Okay. So repairs and maintenance, it can get really big as well. It surprises people. When I was banking, the repairs and maintenance line and the supplies line, they always were more than people expected them to be when they're at the beginning of the year. And speaking of which, supplies, you guys, supplies is a catch-all. There's a lot of things that go into supplies, especially for farmers, especially because a lot of times it's going to be cost of production. When you think about jars and lids and labels and other things that go into a saleable product, that's actually part of your cost of goods sold. So keeping your COGS separate from other supplies like, detergent to wash your bib overalls or whatever it is, keeping those COGS separate from general supplies is going to be really important. That's why I encourage you to have a more detailed record keeping system than just what the Schedule F offers. Taxes. The big question about taxes that I get is, can I write off my sales taxes, right? I'm selling a value-added product. It's accruing sales taxes. I'm collecting those sales taxes and then I'm remitting them to the state. Do I get to write that off? No, you don't, because those are a pass-through tax. I know some people will say, "Oh, well, the tax is built in." Well, it's still a pass-through. Those people still paid tax, you collected it, and you have to remit it back to the state. Now, many of us are in states where we don't have to pay sales tax on a lot of farm products, and that makes it easier. If we're in the value-added or prepared food type of realm, things get a little bit different. Okay, so farm property taxes, Social Security and Medicare, federal unemployment, highway use, and contributions to unemployment insurance or disability. Those are the things that are deductible. Don't deduct federal income tax, don't deduct sales tax, you collect and remit. And lastly, on the expenses side, if you use propane in your farmhouse and you use propane for a heater in your barn, you can probably write off some of that expense, but don't write off your electric bill, your propane bill, your garbage collection, all of them 100% for the farm, unless they're 100% for farm use. You can deduct a proportion of those different things according to your tax accountant's level of comfort. I think I deduct 30% of my propane and 30% of my utility bill for my farm, and everything else is paid for personal. The other is another big catch-all, right? And this, if you've looked at Schedule Cs, if you've looked at the de facto categories that QuickBooks provides when you open up a new account, they put a lot of these things that I have listed under 32 down here in there. So advertising, office supplies, bad debts, business use, legal and professional fees, tools, travel, 50% of meals, and pre-productive period expenses. Again, we're talking about those vines and trees. So you do have the option to expense those pre-productive period expenses for anything that's got 2 years of pre-production time before you get to harvest. So all those other things can go on here. All those others that you would normally see on a Schedule C and not on a Schedule F can go into the other category on the Schedule F. And then the very last thing I wanted to mention is down there at the bottom of the Schedule F, you'll see this box. Check the box that describes your investment. All investment is at risk. Some investment is at risk. The vast majority of you is going to be all investment is at risk. You're sole proprietors. You don't have non-recourse loans, like any of that stuff. It's going to be all investment at risk. The only people that might check some investment at risk is if you're a customer of the FSA or a bank that has a guarantee from the FSA. Some of those guaranteed loans might that guarantee offsets some risk for the bank, and you might not have to pay it back. So that component might talk about some investment, in which case your tax accountant will get to fill out another form and figure out exactly what percentage of your investment is at risk. Generally, that's going to be something, again, the calculation that I would leave to the professionals, if at all possible. Okay, given where we are from a time standpoint, I'm going to skip a couple of these things here and just give you my take-home messages and then go into the chat. So keep good records, classify expenses accurately or as accurately as you know how to. Report income if you've got it and pay the taxes on that income. All right, like that's going to keep you legal. You'll live to farm another day. As a farm finance consultant, I want you to go above and beyond that. I want you to have a profitability goal, not a tax minimization goal. You're farming for business, for profit, for improvement of your lifestyle. You don't want to do it just because you want to avoid taxes. There's way less time-consuming ways to avoid taxes. Use tax professionals when things get complicated, and don't use the Schedule F as the be-all, end-all of what income and expense categories should look like. Get more detailed than the Schedule F when it will behoove the management of your farm business and make you a better farm financial manager. Okay. What did I miss as far as questions, Sam?
Well, we've actually got a bunch in the Q&A, and Catherine and I will go ahead and address those in just a second. I'm going to let you take a break and maybe get something to drink. I have a
Woo!
poll that I need to share with everybody. This poll, actually, I say this every time, helps us when it comes to justifying our free webinar series. And so it's very helpful to us. And it's helpful for us when we get funding. So if you wouldn't mind answering that, appreciate it. And
I
then
can't vote. Oh man, I was gonna give myself great marks.
I'll add an extra one for you. Okay. All right.
All
So
right.
let's start with the Q&A. So and I let everybody, if your answer got missed because there was a lot of questions in the chat by Andy, go ahead and put them in the Q&A, and then Catherine and I, if it's Andy, if you're okay with this, we'll probably combine some questions, and if you're okay with maybe going in to 5-6 minutes somewhere in there over,
I'm good.
because we're
Yeah, let's
officially at
do it.
time. So anyway, so it's you had a lot to share, and I didn't want to cut you short, but although I did light a fire, got you going. Yeah, so we'll try and combine some questions, and if your question didn't get answered or it got skipped, because there were a few that got missed, put them in the Q&A and we will try to get to them quickly. Anyway, all right, Catherine, you want to go ahead and get started?
Do you
Yeah,
want me to stop the share, Sam?
Oh yes, please stop the share. Thank you. Forgot about
Sure.
that.
we had a couple of questions about what to do, how to file, if you're expecting a loss for the year,
Mm-hmm.
and not just a lot. And so that being one question, and then also somebody was asking, um, can I file my Schedule F if it's a loss every year, or is that an issue with the IRS?
Okay, great question. So suffice to say that I've seen farms that manage to report a loss on their Schedule F for years and years and years. Is that a risk for triggering an audit? Yes, it is. Because the government doesn't want you to report hobby losses. They want you to report business revenue, right? The idea behind catching this information is to catch all the taxes that they're owed. So If you are not farming for profit and you are doing it for a loss, that's actually considered sort of a tax shelter. And that is not the appropriate use of a Schedule F. Can you go for 5, 6, 7, 10 years while you're building up your business and reinvest a lot of money and have tons of depreciation and show a lot of loss? Yeah, you can. And will it schedule or will it trigger an audit? Not necessarily. Like, especially the depreciation thing, if you are constantly reinvesting every penny that you make as sales revenue in your farm into machinery for increased production and efficiency, those depreciation losses can sometimes overshadow the revenues, and they can do it for a while. So I haven't seen anyone have an audit triggered by having multiple years of losses in a row. Is it a risk? It's more of a risk than not ever showing any profit.
All right. Dale asks, where are butcher meat processing expenses placed? And I skipped somebody else's question because I want to know this.
It is a great question. I would actually place that in the other. And I would create my own, because you guys, for those of you raising meat and selling cuts or selling freezer beef, processing expenses can get really high. Well, not the freezer beef, depends on how you're selling it. We can get into those technicalities some other time. But processing expenses can be a significant portion of your production expenses. In my opinion, they are a cost of goods sold, right? They're a cost of the value add. And so, yeah, that absolutely needs to go on the Schedule F. There's not a separate line for meat processing. So
Mhm.
I would keep that as a budget category in my 32 other and keep that in some detail on my record keeping, like between species as well. Because I want to know of the meat that I sell, meat versus poultry or beef versus lamb or whatever, which of those things are producing greater profitability for me.
And Andy has done a couple of other webinars with us on, budgeting and all of this kind of stuff. So I will send those out with the follow up email.
Sure.
And I probably will list them. I'll reference them on the website too, Andy.
Cool. What else have we got?
What is a 4A, which I looked it up, is agricultural program payments that isn't taxable? Or are there any?
There's probably a portion or a ceiling to which they are not taxable, and then anything above and beyond that, they are taxable. Sorry, that's a question that's a little bit over my skis, I'm afraid. So every program seems to be new anymore, and every new program has new rules. And I don't have to be on top of all of those things, unfortunately. So suffice to say that all those things that I glossed over quickly in the income side, there's a taxable portion and there's a non-taxable portion. And that is a really wonderful place to ask a tax professional about how much you can go to before they start being taxable.
So is soap considered a farm product? I'm assuming that's soap made from
Mm.
your own tallow or goat's
Or
milk soap
goat's
or something
milk
like that.
or whatever.
Yeah, that would just be a
Man,
value added, right?
that is a short production chain type of item. Is it the kind of thing where you would have to sell that at retail, collect sales tax? Somebody's not going to eat it. It's not necessarily a crop. It's not necessarily a livestock. So technically that's going to be, and whenever I say technically, it means that I might not do it this way if it were me. Technically, that's going to be a Schedule C pursuit, the selling of the soap, the retail sale of soap, because it's manufacturing. You're processing raw farm product into a finished product. If it is a portion that is relatively small of a larger order farm business, would I go to the effort of filling out an entirely different tax form or keeping my business records separately for that soap pursuit? I probably would not. And again, this is not me giving legal advice. This is me giving what my practical brain would probably do.
This is a great question. If you prepare your farm, say build a hen barn, put up fencing, etc., before you get your birds and go into production, can you
Oh,
backtrack a couple of years or more to count this as a cost? And if so, how many years can you go back?
amortization of startup costs. Yes, that is a thing that you can do with your farm. Um, you probably would need to file a Schedule F for that year where you are doing a lot of that startup type of investment. Okay. And is it a backtracking? I don't know if you can backtrack. Like there's so many places where you can backtrack and there's so many places where you cannot. And it gets really confusing as to where there's a yes and where there's a no. But if you have startup costs, like because you're planning on getting into, like the example you gave, you're planning on getting into poultry production next year. I would file a Schedule F this year and say, I've got farm expenses, right? I
Mhm.
am investing in these things. Are they all capital items? Maybe. You can capitalize and depreciate whatever is a farm expense because you don't have a lot of farm income to offset, right? So you'll have some losses, some deductible expenditures for your first year right away, which is pretty cool. So yes, you can amortize startup costs for a farm, I think, and depreciate it over 5 years.
Man, there's so many good questions.
Mhm.
Can we just keep going? Do you mind? Does anybody mind if I,
No, I think I don't have a hard stop until the top of the hour. I am looking to make sure of
We won't
that.
go that long.
we won't go that long. But I mean, I'm trying to eliminate questions. I'm like, I don't know. I want to know the answer to half these
Well, there's
questions.
still 74 people here listening,
All
which
right,
makes it
let's just
fun.
go. We will definitely not go much
You guys
longer
aren't
than maybe 10 more
obligated to
minutes.
stay, but thank you for listening.
Well, maybe I need to put up this and then let me do this really fast, guys. I'm gonna share this. Okay, so I'll do my end of thing. So
Oh, yeah, yeah.
then we can keep going. All right. So we've got a few housekeeping items to share before we sign off. We will send you a recording. We will send you the. I'm not sure if Andy's going to give me the slides or not, but we will send you. I send you.
I
I've
can
been
send you, yeah, I
copying.
can send you slides.
Okay, perfect. So we'll be sending you a copy of the slides, and this will all be on our website. And I also will send a link to Andy's other webinars that he's done with us. So we're finished with webinars for the year, but we'll be back January 6th with So You Want to Be a Farmer. And I will send links to that as well. And don't forget that our Fund to Farmer grants close January 8th. All right,
Is
I'm
there
going
like
to
a
stop the
subtitle to that?
share.
So you want to be a farmer? Are you crazy? Are you just as crazy as the rest of us on this call? I bet you
the
are.
guy who's presenting the guy who's presenting that is just so wonderful. He would never say anything like that.
We are all
He would
crazy people
encourage
in our own
everybody.
right, my friends.
He's a delightful guy. Okay, we'll stop my share. Okay, let's go back to questions. Okay,
Yeah,
I forget whose turn it was. Catherine, is it your turn?
Yeah, so we've got a couple of questions about I think there was some confusion, which there often is, around partnership in the farm, filing as a partnership, etc.
okay.
So I'm going to ask the more direct one. As a farm LLC that's a partnership, will I
Mhm.
submit a Schedule F or just a 1065?
Okay, so as an LLC, you elect to file as a sole proprietorship. If you're a single member LLC, you can elect to file as a partnership if you're a multi-member LLC. So LLCs don't have a tax filing designation inherent to them. You have to choose, you have to elect what tax filing designation your LLC is going to use. So if you're a partnership, oh my God, what is that? Is that a Schedule K? Oh my God, there's so
Yeah,
many
I think you're
It
right.
schedules.
is a Schedule K.
Yeah.
Yeah,
There's so
it
many
is.
schedules. So yeah, I think a Schedule K is a partnership filing. And
Mhm.
sometimes I see sort of a supplement to the Schedule K that has more of the Schedule F categories in it. You guys, it's been a few years since I've been a banker, so I haven't had to paw through everybody's tax returns recently, which has actually been really nice, honestly. Um, but yeah, so 1120 for the Corp, 1120S for the S Corp, Schedule K for the partnership. And I think technically none of those would have to include a Schedule F in their tax documentation. So this is really for sole proprietors, LLCs that are filing as sole proprietors, and certain estates and trusts are the only ones. Okay, I forgot if I answered the question or not, Catherine. What did I get to it?
I think you did. Yeah.
I think you
Right.
did. Yeah.
Yeah, we have some quite a few questions about value added. So one of them was,
Yes.
what if you freeze a vegetable? It was, and then also, what about selling a raw animal product or a dehydrated animal product for dog treats?
Oh boy. Okay, so let's start with the freeze. In my mind, freezing is still preparation
Mhm.
more than it is manufacturing because you're not changing it into another food, right?
Right.
You're
Mm.
still selling frozen farm product. So definitely make sure that you're following the rules as far as temperatures and all that kind of stuff. But I wouldn't have any trouble reporting a frozen farm product sale under the Schedule F. I think even under the technically test, that still feels like a Schedule F type of thing. What was the other type of product again?
So dog treats. So say you're dehydrating dog treats from your products, and would that be considered manufacturing, or would that be considered
So
a
that is
farm
a
product?
state by state answer, unfortunately.
Mm.
So, but I mean,
Um,
if you're putting it on your schedule, would you would put that at that income on your Schedule F and those expenses on your Schedule F?
I think that dehydrating and freeze drying. So if you're selling a pig's ear, right, and you have dried that thing, it's still a pig's ear, right? It's still a farm product. You still got it back from a pig. If you are selling a milk bone where you mixed ingredients, you formed
Right.
those, you baked those, whatever, that's getting into manufacturing. So that would be
That's
more
yeah.
Schedule C in my mind.
That's what I think of it as, is if you're not adding anything to, if you're changing the form of it. So if you're grinding the liver, or you're cutting the liver up, or you're freezing whatever it is, and then you're cooking it, you're dehydrating it, but it's still a farm product because you haven't added anything else into it. So the second you add something to it, then it would be. So then what about sausages? So what if, I mean, you get back your meat from the processor and it's got sausages in it, or you make your own sausages, you're adding ingredients to it, but it's still considered a farm product, right?
I agree with you. It is generally still considered a farm product. I've never heard of any of my meat farmers that say, "Oh, I had to fill out a Schedule C so I could sell the sausage and everything else
That's
sold
good.
under the Schedule F."
Because I do both
Um,
of those things and I don't want to have to do two. So
right on,
I
exactly.
like your answer. It's good. Let's not even talk about it anymore. It's done. You can do it.
It's the
Well, and
practicality test, Sam, right?
there was one more under that same category, which is
Oh,
like
yeah.
candles from beeswax, which is like what you're saying. It's the same thing. You're not adding anything to it. It's just in a different form, right? I mean,
Yeah. I think, and wool too. I
first,
think wool is a farm product too.
but wool turned into scarves. That feels value added.
Um,
See, this gets really complicated, and I
oh,
don't think we're going to be able to answer all of that in this session, but it's
Christelle, that's a hard one.
I mean, this is great because all you value added farmers, you are one of your charges as being a value added farmer is figuring out where you've got to draw the line between farm product and manufactured product. And in my mind, um, a fleece is a farm product. A fleece that is even like turned to yarn still feels like a farm product. But then yarn turned into an article of clothing. Like you can't grow an article of clothing, right? There
right.
has to be a manufacturing step there. So again, practicality test. If you are, if you're selling $100,000 worth of sweaters and five
That's a
thousand
lot.
dollars worth of any other farm products, then you're a Schedule C business, as far as I'm concerned. If you are a farm that's got sheep and you're selling meat, and you're selling skulls, and you're selling fleeces, and you're selling yarn, but you sell a couple of sweaters, am I going to fill out a whole nother tax document just for those sweaters? I'm not.
And Christelle, you will have to decide if you're willing to.
Maybe I'm just lazy, you guys. I don't know.
I don't think so. All right. So Robert asks, actually, quite a few people asked about losing an animal. So Ling is having issues with black vultures, and Robert raises a lot of calves, and was just wondering. So you're going to have losses there. Where do you report your losses? Your animal losses? Because that's
unfortunately losses are not depreciable. I actually have the let me find the right publication here, you guys. I've got so many IRS pubs on my browser right now. It's like the nerdiest my browser has ever been ever.
We can attest to that. We saw it.
We saw it.
Oh my God. Okay. This is publication 225, losses from operating a farm. I'll put the link into the chat.
Perfect.
I think I will. Where's my chat? There it is. There's the link. And so losses from operating a farm. Where is the thing about the doggone? Okay. You can't deduct as a loss the value of raised livestock that die if you deducted the cost of raising them as an expense. So you've already got your cost of production deducted as an expense. So that critter itself, the like retail value of that critter, that's not a deductible loss, unfortunately. Until they come out with some really fantastic life insurance products for chickens, I can't say that that chicken would have produced, this many dollars worth of eggs at my retail. There's just too much proof that would be required to demonstrate that. So no, unfortunately. So if you go, the person who asked that question, go to page 27 of that publication 225, and you can see what I'm talking about.
Okay, let's just do one more question.
Sure.
Catherine, do you want to pick it?
I hate when you do this.
I can pick it. It's fine.
No,
I'll pick it.
Well, okay, this one. Okay.
Actually, I have one I want answered because I'm about ready to put my farm in a conservation easement.
Okay.
Take the pressure off of you. So if you're trying to convert your property to a conservation easement, how much of that would be deductible under the conservation, or would it be deductible under the conservation? Because you're already getting paid for your difference.
So you're going to sell your property, and the conservation organization is going to place an easement on it and then sell it to another farmer. Am I understanding correctly?
Well, I don't know what Christelle's talking about, but when you put in a conservation easement on your farm, which reduces the value of your farm, and unless you're donating it, usually you would get that difference, as a grant or whatever, you would get that difference.
Correct.
That would be reported as on your personal taxes, wouldn't it?
So you would be receiving value from the purchase of that conservation easement by whatever third-party marketplace is buying those things.
Usually it's a government, like it's a grant from the government. For us, we've got a range near us, a military range, and so they're putting conservation easements. They're paying for the conservation easements. They're just being reimbursed for that difference between it being farmland forever and not be developed, and the potential, the value it would have if as a developable property. And so usually
she's saying no, the cost of the survey, etc., not the selling. So that is that's an agricultural maneuver, but it has more to do with asset value than it does with production of crop or livestock. Oh boy. Okay, again, I'm going to give you the non-technical practical answer. If I'm going to have somebody come and survey my farm property, and I'm going to use that survey for farm uses in addition to the conservation easement and all that kind of stuff, I'm going to pay it with farm funds, and I'm going to feel perfectly not guilty, charging the farm for that survey. Is that the technical answer? No, it's not. If you were not an operating farmer, if you were not actively farming at the time and you did that thing, I would feel like it would be more a personal expense than it would be a business expense, because it didn't have anything to do with like renting out the property, for example. So, yeah, estimated cost was around 65,000 for everything. So 65,000 to do the transaction, Christelle. Boy, wow. The right people to ask about that in my neck of the woods would be either the Conservation Fund or the Nature Conservancy. Both of those outfits are in the business of figuring out the conservation easements and the expenditures around doing those conservation easements. Yep, yep. American Farmland. Didn't I say that? No, I said the Nature Conservancy. American Farmland Trust is correct. Lori, thank you for correcting my snafu. Yes, absolutely. The American Farmland Trust.
So we're working with our soil and water district, and they're the ones that do it's actually in conjunction with our open space for our county. And so our
Okay.
county is doing it for us with us.
So what I tell people when things get complicated is to hire a tax professional.
But I really appreciate that, Christian and Christelle, because we're sort of in the beginning process of it, and we'll probably get the funds next year, and so I need to be thinking about that. So thank you, Christelle. But actually, they're paying for everything. So they're paying for the survey, they're paying for everything as part of the
Fabulous.
grant. Yeah, and then they're going to give us money for the difference.
Jessica asked one of the most important questions that I get on a regular basis. Is it okay if I say a minute about that? How do
Yes,
you
one
get
minute,
a
and then
farm tax
that's it.
person?
No
And
more
then that's
after
it.
this.
Okay, that'll be the last one. How do you go about getting a farm tax person? It's really freaking hard. You guys, I have called like state associations of tax accountants and all that kind of stuff, and they don't know who the farm tax people are. It's usually either a large, the people told me I should become one. I love that. It's usually either a large firm with a lot of resources and highly diversified accountants, so that whichever account manager you get pushed to has people that they can call to ask the questions they don't know how to answer. That's one way to do it. The other way to do it is to get in the phone book. And I think I mean the phone book, because sometimes it's even hard to do it on Google, or sometimes Google Maps is really useful, and find a mom and pop accounting shop that is usually somebody's name, LLC, or whatever, and those in a rural area, like not in a city, like out here in, wherever, northern Illinois or southern Wisconsin, on Google Maps, a mom and pop accounting shop, and they won't have a website. You call them and you say, "Do you do farm accounting?" "Oh yeah, I was born on a dairy farm. I know all about that stuff." That's how you find somebody. There are a small number of states that have university sponsored or university affiliated tax accounting systems. In Illinois, we have FBFM, which is Farm Business Farm Management. Michigan has a university affiliated tax accounting system. If your state happens to be one of the lucky ones that has a university affiliated farm tax accounting network, that's the place to go. You will have to be able to give permission for them to aggregate and utilize your data for the larger order record keeping that they're doing for the state that you're in. But they tend to be really, really good. And yeah, mine just retired is a common refrain. Most of the
Yeah.
time, they're older folks that were born and raised on farms, and they understand the dynamics. It doesn't seem like the lack of farm tax accountants has risen to the level of emergency in whoever it is that's training new tax accountants right now. But they are getting fewer and farther between with every year that passes.
All right. Well, we're gonna leave it there. That was a little bit of a downer, but whatever. All right. Thank you, everybody. We really appreciate it. Andy, thank you as always.
Absolutely. Thank you all for sticking around.
Yeah, quite a few people stuck around, so it
And
was worth
yes,
waiting.
the recording, sorry, I didn't want you to sign us off yet, but somebody asked the recording. Yes, that's going out tomorrow. Don't worry.
It is, along with the slides that Andy promises he will send me today.
I'll send you right now.
All right. Thank you. Bye,
Y'all have a
everybody.
good
Thank you.
one. Happy
Thank you so much.
holidays.
Bye-bye.